So you're thinking about investing your money lately, but you're worried you might not do well. Or perhaps you've already started investing for a while, but now you're scared that you're doing something wrong and as a result won't get your desired outcomes. Whatever your case is, ultimately you need a sort of assurance that you'll not lose your money at the end of the day. Whether you're a beginner or a long-time investor, you'll all need the same thing in order to secure your money and thrive in the stock market. And that is having a few good strategies to rely on. It doesn't matter what your financial status is, whether you're rich or poor, if you don't know a good strategy, chances are you're not going to survive long in the stock market. Eventually, you'll either lose a ton of your money, or worst case scenario, all of it. If you're not careful, investing can be your downfall. But when done right, it will be your glory. But fear not, because we're here to help you out on your investing struggles with a few good strategies that have been proven to be very much effective by numerous other investors. Hey, welcome to Stock Market Mate. Today we'll talk about investing strategies that will change your life. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Number 5. Do your own research. Just like work, investing takes a lot of knowing things, such as learning basic financial terminologies and how the stock market works. It's very important to do your own research before getting into these things. Sure, you don't have to know everything, but you need to know important stuff that'll help you succeed. Doing your own research can help you figure out what you need to do next or what your next move is going to be like. It helps you come up with your own strategy as well. Moreover, to survive these things, you need to understand exactly what you're getting into. If you're planning to start investing soon, make sure that you do not get into this blindly and really know what you're going to be up against once you enter the stock market. Be your own coach and educate yourself. Read about value investing. Look up articles about your financial world. To conclude, don't just take what others say or recommend at face value. Inform yourself in order to gain more perspective on things. That way, you'll know what you really want to do. Number 4. Longer time in the market. This strategy will revolve around the time you spend in the market. Instead of wasting your energy trying to time the market, do your best to make your time in the market count. Timing the market hasn't been very successful for any investors in the past and even now. Instead of looking out when the right time is to invest, you should focus more on how to invest effectively. Investing is less about what time frame you invest and more about how long you invest. Stop trying to find the right timing because chances are it's not going to work. It hasn't worked for anyone and it will not work for you now. It is, without a doubt, that the stock market is unpredictable, making it hard to time perfectly. So it's much better to turn your attention to investing wisely as much as you can and for as long as you can. Number 3. Long-term capital gains versus short-term capital gains. The next strategy we're going to talk about revolves around the knowledge of taxes and how it can affect your experience in the stock market. The problem with most beginner investors is that they tend to buy and sell stocks most of the time. They spend the majority of their time in the market buying and selling, and while this can be a fun and exciting way to invest, we wouldn't advise you to do this frequently. The reason for this is because when you buy and sell stocks all the time, there's a high possibility that you will be subjected to a large tax bill, especially when selling stocks for a price higher than you bought it for. Basically, when you do this, you will have capital gains. Capital gains result from the increase in a capital asset's value when it's sold. Invested assets, as well as personal assets, can generate capital gains. There are 2 types of capital gains. One is long-term, and the other is short-term. In short-term gains, a person makes a profit from selling personal or investment property held for less than a year, while the long-term capital gains are profits when you sell an asset held for more than a year. Take note, taxes on the 2 capital gains differ greatly. Short-term gains are usually taxed at ordinary income, so it will depend on how much salary you earn annually. The rate range is between 10 to 37%. Besides that, you might be liable for state taxes as well. On the other hand, long-term gains are usually less taxed than short-term gains. Now you can see why investing in long-term is much more preferable. This is a simple strategy that will help you pay less taxes and gain more money in the long run. Number 2. Prioritizing index funds. When investing, it's so much better to be more consistent in putting money into index funds than into individual stocks. As much as possible, only put extras into individual stocks. Think of index funds as a safer investment. Many investors find it ideal to prioritize their index funds rather than individual stocks. When you've been in the stock market long enough, you will know the reason behind this. If not, then here's why. When you start out investing, you might not always be that knowledgeable when it comes to the nuances of the stock market, which means it'll likely be hard to predict company growth. However, the case is not the same with the economy. Every year, there's at least an assured positive growth in the US economy, hence making them more, if not entirely, predictable than individual companies. Some companies might thrive, but some might not flourish, which means it's going to be hard to rely on individual stocks. Although there may be some corrections in the annual growth of the economy, it doesn't really matter if you just consistently invest. In this sense, investing in index funds is like investing in the economy, which is far more assured of growth than individual companies could ever be. Knowing this, we encourage you to put out the bigger portion of your money into easy index funds, and then put all the other extra funds you have into your selected individual stocks. Number 1. Starting early as possible. Finally, this is very important and can have a really big effect on your results in the future. If you have the means to start your investment journey early on, then we highly suggest that you do. Trust us, you'll be so thankful that you did so when the time comes. Investing in your 20s has shown to be better for your investment portfolio than when you start investing in your 30s or 40s. However, it's even worse for those who start in their 50s or 60s. Researchers have revealed that the time you start investing has way more impact on your money growth than the amount of money that you invest. What this means is that the longer you are in the stock market, the greater your potential profits will be. Why this happens is because investing for a long period of time gives you the benefit of compound growth. Compound growth is how an investment grows on average over the course of several years. Let's say, for example, Lisa started investing when she turned 25 years old with a total of $200 a month. Meanwhile, John started when he turned 45 years old with the same $200 per month. However, because Lisa started earlier, by the time she reaches 65 years old, her contribution would have reached up to $96,000, but John will only have contributed a total of $48,000. Insane, isn't it? But that's just how the stock market works. Every year you delay investing, you miss out on an opportunity for amazing exponential growth, which is why we urge you to start investing immediately, if you haven't done so already. But that's only if you have the funds to do so. If you can, make sure to start as early as possible. In general, the longer you stay in the market and the longer you invest, the greater the effect it will have on your portfolio. You don't have to invest a lot of money, you just have to be persistent. So if you can, start opening an investment account now. And that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!